Good evening, Mwalimu.
Great. The Mwalimu is very audible. So let us start. So sharing my board right now. Sharing my board. We believe that all of us, of course, we do have our block model papers. And specifically, I want us to check that block model paper number 1. I want us to check that block model paper number 1. So sharing in our screen. Of course, we had shared 2 block model papers. That is model paper 1 and model paper number 2. And before that, of course, Mwalimu will take us through some of the specific elements that at least we must make sure that, of course, we are good at. So the questions in our block model paper, they'll just guide us on the main areas, the concepts. So the questions, ideally, we're saying, these will literally guide us on the concepts behind what will be required at least to be very good at, more so on this coming paper, on this coming paper. So I'm just sharing this right now in a few, checking my board on the same. So anytime you are to pass advanced financial management, or when you have to say like to avoid a lot of pressure when it comes to our exams case, there are some specific areas that we need to perfect on, right? And Mwalimu is talking about perfection. There are some specific areas that I want us to perfect on. And as we are looking at our block model paper, these are the areas of our concentration, At all times, whenever we are doing, of course, our revision, even when you're doing your personal revision, these are the main areas that I always want us to be, of course, very good at. These will include, of course, topic number 1, which in this context is really about this topic 1. We know very well that this will never miss. If at all you try do a sample on all the questions that are always tested, the question or the concept of advanced capital budgeting decision, this one will never miss. Advanced capital, of course, advanced capital budgeting decisions, Advanced capital budgeting decision. We know very well that this one will never miss. Advanced capital budgeting decision, we know very well that this will never miss at all times. So most importantly, of course, for this coming case, number 1, we just need to be able to understand that these are concepts that if you have the basic knowledge, then working it out, it will always be a very easy task. Because it is at this point that will be required to have a look at all the concepts that we had considered, such as expected monetary value, talk about the aspect of standard deviation. See, we'll also be expected to understand the key element to do with scenario analysis. We should be able to understand, of course, utility analysis, scenario analysis, certainty equivalent method. So what Mwalimu is trying to say is that before that paper, we must make sure that we've perfected on topic number 1, advanced capital budgeting decision. And specifically this time, of course, we are looking at key areas, which will include certainty equivalent. See, that concept is very key, more so when it comes to this paper this time round. The adjusted present value, adjusted net present value, that concept is also very key when it comes to this paper this time round. So other than looking at this other concept, you'll find that topic number 2 is also very key. We normally have only 5 topics that you must be very good at. So topic number 2, in this case, this is all about portfolio. Topic number 2 is all about concept of portfolio theory and analysis. Portfolio theory and analysis. Portfolio theory and analysis. Rarely, you're going to miss a question about portfolio in exams. Rarely. Rarely, you'll miss a question for portfolio in your exams. Rarely. Where, when you are looking at portfolio, remember these are the basic concepts that Mwalimu guided us previously. You need to understand the whole bit of capital asset pricing models. See, actually, that is always the main thing at this point. If you understand the whole concept behind CAPM, then it should be very easy for you to apply other concepts therein, whereby other key area, unique area, but also very important, the arbitrage pricing model, APM. See, so these are specific areas that you just need to be very good at whenever we are looking at portfolio. So is an area that rarely you're going to miss in an exam. Rarely you're going to miss this concept in an exam. So make sure that at all times we have it at our fingertips. Topic number 3 is also a major key element that you must be very good at. So this is an area to do what? The aspect of advanced financing decisions. Topic number 3. Topic number 3, we are talking about advanced financing decisions. We have advanced, of course, advanced financing decisions. So this is a key area that we must be very good at, looking at some of the key concepts here. Advanced financing decisions. And mostly this time round, if possible, perfect on the concept of WMCC. Yeah. When we read about what? The aspect to do with the breakpoints. See, very key. I've shared a video in relation to this, which we were handling a very complicated question in relation to WMCC. WMCC, key component of breakpoint. Kindly, whatever that you do, make sure that we perfected on this area, mostly. We perfected on this area to do what? WMCC, the concept of breakpoint. Because I know very well, before you come to WMCC, you must have gone through the aspect to do with the component cost of capital, that is cost of equity, cost of preferred shares. We'll be talking about the aspect of cost of debt after tax. Before you reach here, you must have gone through all of these concepts. So topic number 3, advanced financing decision. As much as it is wide, you'll find that some of the key area that at least we should perfect on WMCC with the concept of breakpoint. That will be very important, of course, for us. That will be very, very important, of course, for us. And in this case, of course, there are other key areas that Mwalimu will be guiding us on a specific component here in topics or the concepts are in a block model paper. Topic number 4, in this case, we read about the aspect of mergers and acquisition. Mergers and acquisitions. Mergers and acquisitions. These are also key elements that we must be very good at. Mergers and acquisition. Mergers and acquisition. And finally, of course, we read about corporate restructuring. Corporate restructuring and reorganization. restructuring, and organization and reorganization. See, so I'm not like saying that the other topics like international finance are not important or so on. Mwalimu is saying that kindly, for the purpose of exams, we perfect on these 5 topics. These 5 topics, if I told you do your analysis right now, even in your past papers, you'll find that these 5 topics will literally give us almost, in the computation part, almost up to 70%. Do your analysis today. Do your analysis today of the computation part. Of the computation part, you'll find that this part or the first, these 5 topics will give us almost up to 70% in our computation area. In our computation area, these will give us very good marks. See, so that, of course, the other area majorly to do with the aspect of the financial risk management. That is what we did. Basically, that is a financial risk management, where we normally tend to talk about derivatives and the rest. Also important, but Mwalimu is saying right now is all about strategies, yeah? It's all about strategies. So if I were you, in this case, I'll perfect on these 5 topics. I'll perfect on these 5 topics. Then in addition to that, in this case, you do what? You supplement with the theory part. You supplement with the theory part. There's no way that you're going to not pass advanced financial management. There's no way. If you perfect on these areas, then in that case, you supplement with of course, the theory part. So the other topic, we're also going to look at it, but more to about major areas to specialize in. So jumping to our model papers here, which I believe by now all of us, we should be having the same. By now, all of us, we should be having the same. So let us go to model paper 1. Model paper number 1. A moment, it is picking here. So there's some questions that I want us to look at in that block model paper right now very fast, given the fact that I know we have the aspect of the notes on the same. So Mwalimu will just be going through that concept very fast. Block model paper 1. Block model paper number 1. Block model paper number 1. You can confirm that all of us, we do have that. Come on. Of course, there are those areas to do with the theory part. So let me share with us here. These are block model paper 1. So we have very good questions here that, of course, will always tend to guide us in understanding the whole of these bits. There are very good questions that will guide us here to understand the whole of these concepts. So first of all, I want us to achieve 2 elements today, if time will allow. We talk about the aspect of decision tree, because decision tree majorly will always tend to come with a component of aspect of NPV as well. In addition to decision tree, I'll also want us to look at a major key element here, which is also under our restructuring, and that will be the performance measures, the portfolios, the performance measures, Chappelle's, Kleiner, Jensen's, and of course the appraisal ratio for portfolios P&N. So these will be your target. These will be your target, whereby we analyze. That should be at least question number 4, and we also analyze. There's a good question for decision tree here. Yeah, and we also analyze question number 3. So that will be our target today. That will be target. I believe all of us, you do have, of course, the block model paper. Believing all of us, we have that case. So decision tree, of course, that is advanced financing decisions. So we can start with question number 3. Let us all go to question number 3. Let us all go to question number 3, where we are told like Mobilinet Limited is a company operating in the telecommunication industry. The company intends to invest in equipment that will facilitate wireless internet connectivity to small and medium-sized businesses. The equipment will cost 1.5 million. Additional information, you're told that given the rapid technological change in the telecommunication industry, the equipment is estimated to have a useful life of only 3 years, with no salvage value, right? With no salvage value. The expected annual cash flows from the project and their probabilities of occurrence are dependent on the state of demand as shown below. So we're given the whole bit, that is state of demand, high, average, low, probability, annual cash flows as well. What we are told here is that the company intends to purchase the equipment on 1st January 2026. However, the company has the option of delaying the purchase to 1st January 2027. We have an option of delaying this to 2027. That is what we're given, yeah? In order to obtain further information on the project, the cost of equipment, the cash inflows and probabilities of occurrence are expected to remain same regardless of the project implementation date. So if the project is delayed to 1st January 2027, the cash inflow associated with each state of demand will be known beforehand, and management will only purchase the equipment if a positive net present value is expected. The cost of capital, in this case, you're given 12%. So what are we told? In this case, the good examiner here is telling us that using a decision tree analysis, calculate the expected net present value, standard deviation, and coefficient of variation of the project as at 1st January 2026 under each of the possible implementation dates. We're supposed to advise the company on whether to invest in the equipment, and if so, on which date. So this question, my good students, if at all you analyze it clearly, you'll find that it is taking us back to what Mwalimu has mentioned, that is talk about the concept of advanced capital budgeting decisions, a very key element, advanced capital budgeting decisions. So because we are doing a revision, not a question, what you're doing is a revision. So looking at the whole concept, and by the way, that is how we should always be looking at these model papers. Whatever that you're handling like a question here, let it open door to all other areas that we should always be expected to understand. Because if at all it is a decision tree, in this case, there are these concepts to do the NPV, meaning that straight away we are being taken to the capital budgeting decisions concept, which you must be able to do, which you must be able to understand. So in this case, what are we supposed to understand? Let Mwalimu give us, because we are doing it with finality, I'll give you the concept all around what you are handling. So we start by understanding the capital budgeting. Looking at capital budgeting decisions, what our focus is on this case, remember we're doing this with finality. We're looking at the major concepts here in. So looking at the capital budgeting decision, recall, the whole idea here is that we want to advise the company in making decisions pertaining, of course, capital investments. And capital investments, of course, these are long-term investments, which ideally they are expected to last for more than one accounting period. These are what you're looking at about what the capital budgeting decisions. So then, what are the main elements that we need to grasp on capital budgeting decision? that will enable us to open the door in so many other cases. Because at this point, we are talking of the capital investments. Key areas to master will be what? We need to understand that in looking at capital budgeting decision, we will be having various basic methods that we'll be considering, first of all, so that in the event that this is being tested in any area we are good at. So the basic elements that we'll be considering here, number one, you must be able to understand the concept of NPV, that is the net present value. Net present value. Net present value, the whole concept here is that we are looking at simply net present value here. We are simply looking at the key component to do with what? The difference between our present value of cash inflows. So talk about NPV being equal to the difference between our present value of cash inflows with less our initial outlay. See, less our initial outlay. So present value of cash inflows will less our initial outlay. Where in this context, anytime you talk about this cash inflow, recall the cash inflow that you read about here is all about what? Annual net after tax cash flows. See? The cash flows that you're reading about here, you should be able to understand that you're looking at what? The annual net after tax cash flows. Annual net after tax cash flows. These are what we are considering at this point. Annual net after tax cash flows. So that in this context, it will be important for us to be able to understand that these annual net after tax cash flows, how are you going to determine your annual net after tax cash flows? How are we going to determine this annual net after tax cash flows? This will be easy because you will be required to have, of course, your cash flows. In this case, we'll talk about your contribution. We talk about our contribution here. We're going to less our fixed costs. We're going to less our fixed costs. We have contribution. We're going to less our fixed costs. We are going to less our tax. You less your tax. In this case, we are going to add what we are referring to as depreciation tax shield. That is our DTS, depreciation tax shield. We are going to add, my good students, a very key element, working capital recovery at the end of the period. And we're going to add residual value here. See, you're going to add residual value. So if I told you to look at it in the context of the statement, of course, by now we should be able to understand how to go about our contribution. We should be able to understand how to go about our fixed cost. We should be able to understand the aspect of tax, the aspect of DTS, and the aspect of working capital recovery, plus what? The residual value. In this case, we should be able to understand this concept very clearly. And at this level, what you should expect, there's a question that, there are three questions that I'm going to share, but among the three, there's a very good question whereby you're being tested on this. So at this level, the most complicated part that it can be where you are given tax or no tax, but depreciation, you're given depreciation in a reducing balance basis. Reducing balance basis. Say, when you're given your depreciation or reducing balance basis and you're working out NPV, how will you be able to handle that? There's a very good question that I think I'm going to share. That is in our last block model paper 3, which has only like 3 questions. So in this case, you need to be able to understand this. All times that you read about what? The aspect of NPV. The aspect of NPV. So if we get to understand this, I know one will ask Mwalimu, Can you remind us how do you normally determine our depreciation tax schedule? For you to determine your DTS, always we have to take our corporation tax. In this case, we multiply by our depreciation. You multiply by our depreciation. It will become interesting when you are dealing with depreciation of reducing balance. Anytime you're having depreciation of reducing balance, you'll find that there's a point whereby majority of the students, by the way, they normally tend to get a challenge on depreciation on reducing balance. But if at all you'll be able to work that one out, then the rest of the things will always be very, very easy for us to be able to understand. See, so make sure that we master these correctly. And where you're having a question, by the way, this is the best time to ask. You might not get any other question to ask later on. So make sure that we have this right. The other advantage or the other sweetness that you can be asked on this, it is on the concept of adjusted net present value. You see, we are jumping to the next concept, which is what? Adjusted net present value. I think there's a question here, right? I think there's a question in our block model paper, which we are tested about adjusted net present value. I think there's a question, yeah? There's a question. There must be a question. Exactly. See, so these are model paper. That's question number 1, part B. So you find that in this context, other than the normal NPV, what we are used to, what if now we are asked about adjusted net present value? The most important thing of going through the whole concept. See, so we have adjusted net present value. Adjusted net present value. If you've been able to get NPV right, adjusted net present value shouldn't be an issue. It shouldn't be an issue. Why? Because at this point, what will be required to do, my good students, is we are looking now, whereby at this point we're looking at a case whereby we are modifying. See, the whole bit is that we are doing a modification in our net present value, where in this case, what we need to do, we need to account on the aspect of debt components. The debt components, all other financial factors other than us financing our operation using maybe debt component, unlevered, whereby we don't have any component of debt. In addition to this, what will be the effect of the debt components in our investment? What will be your debt component in our investment? So anytime you are asked to determine our NPV adjusted, you must always remember that you need to determine NPV, in this case, of unlevered farm. And the whole concept of NPV is what Mwalimu has guided us on this case. In this context, we are going to consider, we add the present value of all these other financial effects, financing side effects, present value of our financing side effects, present value. I remember Mwalimu taking us through the concept of present value. See, so there are 2 elements of NPV that we must be able to make sure that we have gathered clearly. Because we are saying this is our revision, it's not just about the question, it's about the concept surrounding the question. That's what Mwalimu is really insisting on. So once you're able to understand the concept of NPV, what if you're asked the adjusted net present value? This one will be aspects of very easy, whereby you need to now consider the net present value of their levered. If at all we assume we are financing our farm with all equity, then consider the present value for financing side effects. That is very important to note. What else can we expect whenever we are dealing with NPV? Expected net present value. So we have expected net present value. Remember where we've come from. We've come from understanding NPV. We go to understanding the adjusted net present value. We are looking at expected net present value. One paper can come testing us on all these concepts. Whenever we are having the expected net present value, the whole idea here, we are now incorporating what? Our probabilities. NPV, in this case, we are incorporating our probabilities. See, probabilities. So this is what we are incorporating. And many a times, the expected NPV, you might be given now in form of a decision tree. Like the question that you have in here for decision tree, the question that you're having here for decision tree, you'll find that the whole idea is still the same concept, but now the question that you want to handle here, see, you are being asked for what? The expected net present value. See, my good students, so these are all versions that the net present value can be tested. Consider the normal NPV. Consider the aspect of adjusted net present value. Consider the aspect of expected net present value. This revision time, we are going to look at all these concepts. You have the adjusted net present value. We have the expected net present value, the one that for decision tree, and you have the usual or normal net present value, the one that, of course, as I've said, it is on a block model paper 3. So all these concepts would be expected to understand them clearly in that manner. So after we are done with the concept of NPV, expectation, NPV normal, how do you go about NPV? Mwalimu has guided us. Aspects of adjusted net present value, aspect of expected net present value. We should be having this in our fingertips. We should be having this in our fingertips because this is what will affect all the other elements. Higher. Once we are through this, we go to the next element. Our focus, remember, of course, we'll be looking at the whole concepts of NPV here. So let us go and look at another element which is also vital under the basics part. We have internal rate of return, IRR. Internal rate of return, commonly known as IRR. Commonly known as IRR. We are doing this so that when we start our questions, we just be working out all at the same time. We're looking at the concept of IRR. You cannot do IRR or you cannot handle IRR if at all you're not good on NPV. That is to say, first thing first, you must be having our NPV. That's the first thing that you need to have. So looking at our internal rate of return, in this case, the good examiner can use this term. Determine the break-even of NPV. Break-even, remember the impact, we did impact analysis, right? We did impact analysis and scenario analysis. So you might be asked to determine the break-even point of NPV. When you're asked the break-even point for NPV, what the good examiner wants you to determine is simply what? Is simply IRR. Don't now wonder like, sisi mwalimu hakutufunza anything to do with aspect of break-even NPV. When you're asked the break-even NPV, clearly in your mind, just know that you're being tested on the concept of what? IRR. Clearly, in your mind, you just know that you're being tested on the concept of what? IRR. So it must be very important to know how to go about IRR. So how will you go about IRR? Because we are looking at IRR as simply at the rate where my NPV is equal to 0. That is to say, before you work out your NPV, you must be having, before you work out your IRR, you must be having NPV. So to determine IRR, this is known as what? Trial and error method. Trial and error method. You must consider the following. We take the lower rate that we'll be having. In this case, we are going to add the NPV of the lower rate. We are going to divide by NPV of the lower rate with less NPV of the higher rate. In this context, we multiply by higher rate minus the lower rate. Very important element to note that anytime you talk about IRR, internal rate of return, we should be having the lower rate plus NPV of the lower rate. In this case, we are considering the NPV of the lower rate minus NPV of the higher rate times the higher rate minus the lower rate. That is to say, where are we going to get the higher rate or lower rate? First thing, after you have worked out your NPV, in the event that your first NPV, you have determined it to be positive. You have determined your NPV to be positive. Because you are saying that IRR is a trial and error method, what would be expected to do, my good students, here now is very clear. If your NPV is positive, the gaze rate that you're going to take, let it be higher than the one that was used to compute what? The first NPV. If your gaze, or rather if your NPV is positive, let your gaze rate be higher than the rate that was used to compute our original NPV. In the event that you get your NPV to be negative, the gaze rate here should be lower than the one that was used to compute what? Our NPV. If your gaze rate is, or rather if your NPV is negative, the rate that you're going to gaze, let it be lower than the one that was used to compute what? Your original NPV. That is very important to note. Very key to note. Very key to note. Once we have this in mind, the next important bit will be what? Now, there's a question here. Now, there's a question. This is the best time to ask. Now, there's a question. This is the best time to ask. Okay. So once we have determined this element, then that should take us to profitability index. Profitability index. PI. Profitability index, my good students, in this context, you're looking at simply the ratio of the present value of our cash inflows with what? Our initial investments. So PI, profitability index here, we are talking about simply the ratio of our present value of cash inflows. We are going to divide by our initial investment. We're going to divide by our initial investments here. And when you are having projects that maybe you need to consider in aspect of the project to select or project to abandon, then you'll find that the PI will be very important for us to note that anytime you're considering the aspect of profitability index, consider the present value of cash inflows divided by our initial outlay. So that in this context, if your PI is more than 1, see, if your PI, in this case, you worked out your PI and you found that it is greater than 1. So then, in this context, this project should be accepted, or this project is viable. When your PI, in this case, you realize that maybe it's less than 1, then this project is not viable. It should not be selected. When you get to find your PI is equal to 0, then we are at a point of indifference. We can either select the project, or in this case, we cannot select the project. So it will depend with the management. It will depend with the management. This is a very important key element that we should be able to note. Profitability index.
To 0.
Yeah, question?
Mwalimu. Equals to 0 or equal to 1?
Equal to 1. Thank you. Equal to 1. Yeah? Equal to 1. Equal to 1. So in this case, you're saying that when my PI is equal to 1, you're saying that this is a point whereby the company is in a case of indifference, meaning that they can either select this project, or they can either accept or reject. So it depends on the management in this case. But when you're looking at greater than 1, the project is profitable. Less than 1, the project is not profitable. Equal to 1, the point of indifference. So these are the main elements. Other than the payback period, which I believe payback period, we are not ignoring it, but payback period, I don't think if at all is that complicated. Whereby payback period, you're just looking at it as considering the period, yeah, considering the period that you take us to recoup back our initial investment, considering the period that you take us to recoup back our initial investment. So these are very key elements. So in this case, what I'm going to do, let us, I know I have not shared with you, I wanted to share with you towards the end, but let us do this question now very fast, because it will form a basis in all other elements. Let me share this question with us. Let me share this question with us. It will help us a lot. It will help us a lot to understand the whole concept that I want us to get to know. So let me share this question with us. It is in our blog model paper 3, so I'm going to only pick that specific question. I'll be picking that only specific question. I'll be picking that specific question only. In our blog model paper 3, we have only like 3 questions as I've stated. Hiyo ilikuwa ni kazi yenu mfanye, but because of this concept, which is very important, I'll have to share with us so that we should be able to understand. And what Mwalimu is trying to do here is to help us on the thought process. See, Mwalimu here is helping us on the thought process. Given a question, how best can you analyze it? That is what you're looking at this point. That is what we are looking at this point. So this is what we're having. Let me share it in our, allow me to share it on our Zoom chat. Allow me to share it on in our Zoom chat. Allow me to share it in our Zoom chat. It was a very good question, and you'll find that these are areas, if at all majority of students were given, they'll always be like, now what are these? We've never been told this. Start so many stories, yeah? So these are what you're having. Allow me to share in our, allow me to share in our chat. Allow me to share in our chat. allow me to share in our chat here. I know if at all you are done with that question, I'm not sure if at all there's a question for NPV other than the one that will be given, probably the aspect of from contribution. So this is a So come on. It is not complicated. It's something that it's just a matter of reasoning out. So it is not like that is something complicated. Okay? It's not like something complicated. So confirm that you have received in the Zoom chat. Confirm that you have received in the Zoom chat. Confirm kindly.
Received.
Received. Great. Great. You received? Okay. I believe that all of us, we have received. So in this case, these are what you asked. These are what we were asked. These are what you asked. It is a question whereby you find that by the look at it, you might find it, or rather you might think that it is somehow very complicated, but it isn't. You'll find or you think that it's very complicated, but it isn't. So let us go through this part so that we go now to a question of our decision tree very comfortably. This is part of our block model paper 3. So these are what you're told. Specifically part B, specifically part B of the question. These are what you're told, that School Tap Limited manufactures a component known as Tap, which is used in the manufacture of locally assembled desktop here, while the current production capacity is 1 million units of Tap. Demand for the component is expected to be, of course, to be as follows. So what we are given year 1, 2, 3, and 4. Demand 1.4, 1.5, 1.6, 1.7. We're told the company is planning to acquire an additional machine at a cost of 8 million, which will have a useful life of 4 years and a maximum output. Underline the word maximum output of 600,000. The scrap value of the machine after 4 years will be 300,000. Okay? Higher. We're told the current selling price of Tap is 80 per unit and the variable cost is 50 per unit. Other variable costs of production are 19. Fixed cost of production associated with the new machine will be 2.4. The fixed cost associated with the new machine will be 2.4 in the first year of production, increasing by 200,000 per year in each subsequent year of operation. School Tap Limited pays tax 1 year in arrears at an annual rate of 30% and can claim capital allowance on a 25% reducing balance basis. Reducing balance basis. A balancing allowance is claimed in the final year of operation. That was also another catch element. Where we are told that we can claim a balancing allowance at the end of the financial year, or rather the end of the final year. that was also another catch area. What we are told by a good examiner in this context is that the cost of equity for school tap is 10%. And in this case, we also told that the cost, we told, where is that bit here? The cost of equity for school tap is 10%, while it pays an interest of 8.6% on its debts. Its long-term finance is made up of 80% equity and 20% debt. So look at what you're required to do. Number one, in this case, calculate the net present value of buying the new machine. Calculate the internal rate of return of the new machine. Calculate the profitability index of the new machine. Calculate the discounted payback period of the new machine. And you're supposed to advise the management of School Tap now on whether to buy this new machine or not. Okay. So this question literally, it is covering areas that they seems to be basic in our class, and they are also part of capital budgeting decision, but we find that there are some elements that they have added for us there for us to think widely. For us to think widely. So given such a question, as Mwalimu has always mentioned, we put our variables down. We put our variables down first to help us to tackle the question effectively. So we start. Currently, where sorry for that, mic went off. We're saying that currently where we are sitting, our current production capacity is 1 million. So, meaning that whatever that this new machine will be bringing to us are simply the additional elements that we'll be having. Simply the additional elements that we'll be having. This is what new machine will be bringing to us. The new machine will be bringing to us the additional elements. So, in this case, so you're asked to work out the NPV. As always, Mwalimu always guides us. Like anytime you're asked for the case, we need to create a good impression. NPV. NPV, you need to determine the present value of our cash inflows. We need to determine here the present value of our cash inflows. See, we less what? Our initial outlay. We less our initial outlay. These are very important elements that we need to do. So what are our cash flows that we're given? Identify the cash flows that we're given in this context. If we check our cash flows here, we are told, number one, that we have this farm. Our farm, in this case, these are the units that you're having. So talk about year one. We do it as we proceed. We have year one, year two, year three, year four. Year one, year two, year four. Year one, year two, year three, year four. The impact is on this new machine that you're bringing into the company. So we talk about what? Consider our units. The units that this new machine will be bringing to us. Currently, we're having our production of 1 million. Year one, we had our demand is estimated to be 1.4, meaning that what is the effect of this new machine? How many units are we going to take that this new machine will bring to the company? How many units are we looking at that point? 400. Why? Because current production capacity is 1 million. We want to look at the effect of this new machine. So we agree that out of the 1.4, the effect of this new machine is only 400,000 or 4 million. So we take the units there, our values maybe to be in thousands. We take 400,000 on the first case. The other case, we take what? 500,000. Year 3, we take 600,000. Year 4, what are we going to take? We are given 1.7. But if at all you go through the beauty part of us writing our variables, if I told you original variables, it could have been very easy. We're told the company is planning to acquire additional machine at a cost of 8, which will have a useful life of 4 years and a maximum output of 600,000 units. So if you check year 4, we are passing that excess of 600,000. I can only produce a maximum of 600,000. So therefore, we take what? 600,000 here. These are units that the new machine will add unto us. The units of this new machine will add unto us. The next element is what? Mwalimu has told us that, you know what? For us to arrive at our element of cash flows, in this case, we'll be taking our contribution. We'll less our fees costs. Then we less our tax. At this point, it is upon us to remember, how do we normally achieve our contribution? I want to remind Mwalimu, how do we achieve our contribution? We normally can take what? You can give Mwalimu that fast. How do you normally achieve our contribution?
Selling price minus variable cost.
That is contribution, margin. I need contribution.
Selling cost minus variable cost, you multiply by the quantity.
Quantity. Very good. Selling price per unit minus variable cost per unit times the quantity, or simply you talk about what? CMQ. This will give us our aspect of contribution. So in our variables, my good students, can someone give Mwalimu contribution margin? Are there elements that you are guided for contribution margin? Are we guided for contribution margin? We check it out. The current selling price of tap is 80 per unit and variable cost is 50 per unit. Other variable costs of production are 19. Fixed cost of production costs associated with the new machine we are given at that point. So, can we determine our CM? Someone give Mwalimu our CM. What will be our CM here? Zainab is giving us 30. Zainab is giving us 30. We're about 80 minus our variable costs. Variable cost, we had what? We had 50 plus other variable cost of 19, right? So 50 plus 19. This will be a variable costs total. So that as at the end of the day, we will be talking of our contribution margin of how much? Because the total variable cost is what we need to consider here. So that should give us 80 minus 50 minus 19 to give us 11. This is our contribution margin. So therefore, we come and take our CM 11, 11, 11, 11, because that was not changing. So that eventually, as at the end of the day, we can determine our CMQ to be how much? Determine our CMQ. We take 400 by 11, which will give us 4.4. So you take 4.4. We have the other value, 500 here by 11 to give us 5.5. You can confirm. 600 here by 11 to give us 6.6. And this one, 6.6. Consider our fixed costs. Remember, our target here is that we want to achieve what? We want to achieve our annual net after tax cash flows. Consider our fixed costs. Consider our fixed costs. How much were we given as our fixed costs? We check it out. How much were we given as our fixed costs? We are told, and on the same note, that fixed cost of production associated with the new machine would be 2.4 in the first year of production. Increasing by 200 per year in each subsequent year of operation. See, given that at this point, recall, our values, we've not taken them in full. We've taken our values in this context into thousands. These values are in thousands here. Our values here are in thousands. Yeah. Are they in thousands? Let us see. That was actually they're in full, right? Because that was 400, 500, 600. We've taken them in full. So that is just in shillings. We've taken them in full. That is shillings. Shillings here. We've taken them in full. We've taken them in full. So we determine our fixed cost. First year will be 2.4. First year will be 2.4. We're told the next period is going to be what? In the first year production, increasing by 200,000 per year in each subsequent year. Increasing by 200,000. So can someone give Mwalimu how much will we be having in year 2? 2.6. Year 3, 2.8. Year 4, that should give us 3 million. Confirm. 2.4 increasing by 200,000. Increasing by 200,000 subsequent years. So that as at the end of the day, what will we be having here? As at the end of the day, what will we be having here? Cash flows before tax, or profit before tax, or simply cash flows before tax. Cash flows before tax, we should be talking about 4.4 minus 2.4 here to give us a value of 2 million. We have 5.5 minus 2.6 to give us 2.9. We have 6.6 minus 2.8 to give us 3.8. 6.6 minus 3 million to give us 3.6. Okay. That is our profit before tax. We need to determine our tax component here. We need to determine our tax component. If we check our tax component, let us see what you're given. We are told that school TAP pays 1 year in arrears. That is the catch. That is the catch. In arrears. In arrears. At an annual rate of 30% and can claim capital allowance on a 25% reducing balance basis. So, in arrears. This is to say The tax in year 1, we pay in year 2. Remember, we want to look at our cash flows, the essence of NPV. The tax for year 2, we pay in year 3. Year 3, we pay in year 4. Year 4, continuing all the way to this year, meaning that we'll have to add another year. This is what you're saying. The tax for year 1, we take 2 million times 0.3. This one we are going to pay in year 2. The tax for year 2, 2.9 times 0.3, we pay in year 3. The tax in year 3, 3.8, we pay in year 4. And therefore, because of claiming the aspects of depreciation tax shield, we will have to add year 5 here, where we read about 3.6, in this case, times 0.3. This one we are going to pay in year 5. These are tax till 80. See, the most interesting part of this question, it was testing us on our logic, so that eventually, when you want to determine our cash flows after tax, or simply profit before tax, after tax, that is the case, cash flows after tax, we have 2 million, we have 2.9 minus 600 to give us 2.3. And where you're not getting the concept, kindly ask. 3.8 minus 870, 2930. 3.6 minus 1140, 2460. And we have 1080 value here. See, after doing this, according to our guide, we need to determine what? Depreciation tax shield, DTS. We need to determine our DTS. Depreciation tax shield, we agreed, we are talking about tax times our depreciation. In our case, the juicy part of this question, we are told that our depreciation is on a reducing balance. Say, depreciation is on a reducing balance. So what are we going to do next? This is what we are supposed to do. And we follow the steps clearly here. I hope this space will fit. I'll just squeeze it. Depreciation is on reducing balance. So for me to determine my capital allowance, I need to establish this depreciation. How will you go about it? Of course, we have our year. So year 1, year 2, this one, year 3 was going up to year 4. We have the cost. Consider our depreciation now and our net book value, doing it as form of our working. Doing it as form of our working. Depreciation, how much are we given? Check depreciation value. Depreciation value, we are told that Sculptor pays tax 1 year. In this case, we're told the cost of equity, there's a depreciation where you're given somewhere, yeah. Capital allowance. Sculptor Limited pays tax 1 year in arrears at an annual rate of 30 and can claim capital allowance on a 25% reducing balance basis. So what was the cost? The cost, how much are we given? The cost is 8 million. So you take a value of 8 million, So allow me to write 8,000 there. Depreciation in the first year, how much are we going to have? Someone to give Mwalimu? Depreciation on our first year, how much? 25% of that value, 2 million. Net book value, how much should you be having? Consider, this is what you're doing, that cost is 8 million. Capital allowance, 25% of 8 million to give us 200. Our net book value, therefore, we agree, we have 6,000. Net book value is what you're going to have here in year 2. So we take 6,000 by 0.25 to give us 15. Net book value, 6,000 minus answer to give us 45. So we have 45 times 0.25. Confirm if I told you you're on the same page. 11 to 5 minus answer 33.75. You confirm if at all we are on the same page. So that year 4, what were we told? We need to claim everything. We need to claim everything. Yeah, this question had a lot of mitego, right? So year 4, we are told that we need to claim everything. A balancing allowance is claimed in the final year of operation. This note, a balancing allowance is claimed in the final year of operation. So what is our balancing allowance here? What is our balancing allowance in this context? My balancing allowance will agree we are taking, if at all we are given any salvage value, we have to consider it, because we had, of course, our current value cost was 8 million minus our depreciation all through up to year 4 or up to end of year 3. We are talking about 2,000 plus 1,500 plus 11 to 5, which ideally, if we less this one, should give us our net book value, 46.25. 46.25. So we're having 8,000 minus answer 33.75. You see, it is giving us this value. Confirm if at all we had residual value. Confirm if we had residual value. Confirm if we had residual value. Let us see. Confirm if we had our residual value. We are given, in this context, we are told the scrap value of the machine after 4 years will be 300,000. Scrap value will be 300,000. So we come and take my scrap value of 300,000 here. So we agree minus 300, which will give us 37.5. So this is what I'll be claiming as at the end here, 37.5. Because as at the end of the 4th year, my net book value is supposed to be 0. We are given the balance is to be claimed as at the end of the period. So we have our depreciation component. Our target is depreciation tax shield. Where you're not getting the concept, make sure you ask. Where you're not getting the concept, make sure you ask. I know this question was very good. This question was very, very good. Where you're not getting the concept, make sure you ask. So once we have determined our depreciation, we can easily come and work out our DTS. But remember, depreciation tax shield will go hand in hand with when we are paying for taxes, because depreciation tax shield is simply the effect of this depreciation to the tax component. So we are going to have this depreciation component in the year that you are paying our tax. Our taxes were being paid in arrears. Our taxes were being paid in arrears. So then, my tax shield, year one, 2,000 by times 3, times 0.3, 600,000. 600,000, I am doing it in arrears. 600, we are doing it in arrears. We add, just as Monimo has guided us when you are starting. 1,500. 1,500 in this context, that is of course 1.5 times 0.3. We have 450. In year 2, that is in arrears, we have 450 here. 1125 times 0.3, we have 33, 337, 500 in arrears. 3075 times 0.3, we're having 922, 500 in arrears. In arrears. In arrears. Have that. And where you're having a question, make sure you ask. You're having a question, make sure you ask. You're having a question, make sure you do what you ask. These are our question here. We are following each and every step. Yeah, the question ilikuwa na mitego kabisa. So once we have achieved our aspect of DTS, were we given any value to do with our component of what? Were we given any value of our residual value? Yes, we had our residual value. Were we given working capital recovery? We are not given. So you take residual value as at the end of the period, 300,000. Residual value, in this case, we come and add, this is year 4, 300,000. So that as at the end of the day, if you want to determine our annual net after tax cash flows, what will you be having? These are now our annual net after tax cash flows. Annual net after tax cash flows. Actually, we find that our job was coming up with that cash flows and the component of reducing balance and the aspect of tax in arrears. So what will we be having here? We can consider this should give us, of course, 2 million, 2.3 plus 600, this should give us 2.9. 2930 plus 450, this should give us 3380. We have 2460 plus 337.5 plus 300, this should give us 3097,500. And finally, 1080 plus 922,500, that is 1080, 922,500. Mwalimu is getting a value of 157,500, but negative. annual net after tax cash flow. Annual net after tax cash flow. So that now we start our questions. Where you feel you're having a question, this is the best time to ask. Where you feel you're having a question, this is the best time to ask. This is the best time to ask. Where you feel you're having a question. Where you feel mwalimu kindly kusema ukweli mimi hapa sijaelewa. Can you redo it again? Mwalimu would be here to redo that part. Where you feel mwalimu should redo, mwalimu would be here to do that part. You just say a word. So, if at all, yes, please.
How did you get the first split? 400.
To get what?
How did you get the first split? The 400, 500, 600. I lost my network.
In this case, we are given, look at this case, the units you are talking about, right?
Yes, yes.
Look at this case. We're told School Tap Limited manufactures a component known as tap, which is used in the manufacture of locally assembled desktop computers. While the current production is 1 million. Currently, we are doing only 1 million. That is what the company can do. Tap demand for the component is expected to be as follows. This is what is expected demand, but only we can do only 1 million. The reason why we are told the company is planning to acquire an additional machine at a cost of 8 million, which will have a useful life of 5 years and a maximum output of 600,000. So we are acquiring this new machine, which will help us to supplement in our production. So the effect here, because you are asked, all these questions were based on the new machine. So we are looking at the impact of the new machine. So year one, the company currently can only produce 1 million, meaning that what was the effect of this new machine in year one? It was 400,000. The 1.4 will less the 1 million that the company can literally produce even without this new machine. The same case in year two, 1.5 total demand, but what is the impact of this new machine? The impact that the new machine gave us was what? Only what? 500,000. So in that case, we go to year three. Year three, 1.6. The effect of this new machine will be what? 600,000. Because without this new machine, the company can still do what? 1 million. In year four, we have 1.4, 1.7. But we are given a caveat. The maximum output that this new machine can give us is only what? 600,000. So I cannot go beyond 600,000. So that's why in year four, we've also taken what? The 600,000. So the reason why these quantities, we are having them here. 400, 500, 600, and 600. Because year four was 700 and our maximum was only 600,000. So that's how we got the quantities. Is that okay? Great. I can see Zainabu hapa anatuuliza. Zainabu, she's asking about capital allowance. So where we are coming. Okay. So in this case, you'll find that we are claiming this value as at the end, given the note. Look at this case. We're given a value here. We're told that School Tap Limited pays tax 1 year in arrears in an annual rate of 30% and can claim capital allowance on a 25% reducing balance. A balancing allowance is claimed in the final year of operation. In the final year of operation. Balancing allowance. So what you're doing in this context, that is to say, as at the end of year 4, I don't need to have anything in the books. Everything should have been, or everything that is remaining is going to be claimed in year 4. Everything that is remaining is going to be claimed in year 4. We are going to claim the balancing allowance in year 4. So, because it is reducing balance basis, you see, this asset had a residual value that we given 300,000. So we start by determining your depreciation in year 1, year 2, up to year 3. The useful life was only 4 years. So we take what? Cost minus residual value, the way we usually do, to give us what? The balance that we'll be having. So in other words, it's as if you're talking about cost, which is 8 million, you less your residual value, 300,000. We are going to remain with a value of what? 8 million minus 300 to give us 7.7. 7.7, this asset has been depreciating all through the years up to year 3, because everything needs to be claimed in year 4. I don't need, or we don't have to have any balance. So we come and determine what is the accumulated depreciation up to year 3. We talk about 2 million plus 1.5 plus 11.25, which we get 46.25. So of the total cost, and we deduct the residual value, what is remaining as at the end of year 4? What is remaining, Zainab, as at the end of year 4? 7.5 minus 46.25, which you are getting 30.75. So this balance, I will have to claim it all in year 4 as per the instruction that you are given. So that's why we have what? 30.75 there. The relevance of us having a value of year 5, or rather adding year 5, it is because of the tax effect. This amount is an expense that I'll have to pay. It is not that after the useful life of this machine and I still had an outflow. Remember, we already told that this outflow will not go. We still have to pay this cash. This cash we still have to pay. So that's why there's a component of tax in arrears, in arrears, in arrears. This cash I'll have to pay it, whether in operation or not. I'll have to pay the component of tax. And this component of tax was also affected by the depreciation tax shield. And that's why we need to have year 5, because this will be an outflow. It is not that after the end of this year's project, you're going to close this value. It is as a result of this project. The 1080, or the component of tax effect here, it is as a result of this project, which in this case, it means that it is an outflow relating to that specific machine. And that's why we need to add year 5. Zainab, is the question answered? Aha, great. So once we have this case, this is where, or what we are supposed to determine. Imagine, our journey was to lead us to this point. Our journey was to lead us to this point. So that now we go to our question. Allow me to raise here, because here we are done with it. We go to our question, my good students. Let us go to our question. Do you know how to work out NPV? Do you know how to work out NPV? We need to have our period here. You talk about years. We have year 1, we have year 2, we have year 3, we have year 4, and we have year 5. What about our cash flows? We have determined our cash flows. Our cash flows being year 1, 2 million, year 2, 2.9, year 3, 3380, year 4, 3097, 500, 157, 500. Negative. We have our cash flows. What we need to ask ourselves is this. These cash flows, are we going to use the lump sum component or are we going to use the annuity part? Someone said money. Are we using lump sum or are we using annuity? I gave us when you are starting, of course, earlier on in our coursework, when to use annuity and when to use lump sum. These are lump sum. Our cash flows are irregular. So then we have present value interest factor. What rate are we going to use? What rate are we going to use? What rate are we going to use? Let us see.
10%.
How much?
10%.
Let us see. We're told this is the cost of equity, KE. Yeah, we're told the cost of equity for school TAP is 10% when it pays an interest of 8.6 on its debts. Its long-term finance is made up of 80% equity and 20% debt. So what the good examiner is telling us here is to work out our WACC. WACC. The good examiner is telling us to work out our WACC because we're given cost of debt and cost of equity. And we have our weight. So we have to compute our WACC. Where, you know very well, WACC is about weight of equity times cost of equity. We're going to add weight of debt times cost of debt after tax. So in this context, we agree that my WACC, therefore, we take what was the weight of equity given? We check the weight of equity given. Weight of equity you're given, that should be 80%. So we have 0.8 times 10. We add weight of debt 0.2 times after tax cost of debt. After tax cost of debt will be 8.6. Yeah. 8.6 times 0.7. That will give us after tax cost of debt. So in other words, our WACC, we are going to consider 0.8 times 10. We add 0.2 times, in this case, 0.2 times 8.6 times 0.7. So Molino is getting 9.2%. 9.2%, which is equivalent to 9%. Which is equivalent to 9%. So then that would be our weight or cost that you're going to use here. So we have 9%. Because we know it is lump sum, you should recall 1 plus R raised for negative n to determine our factor. 1 plus R raised for negative n. So that in this context, determining that it will be easy. Why? Because now, in our case, like year 1, we are going to talk about 1.09 raised to power -1 into 4 decimal places. We have 0.9174. You don't need to repeat this formula all through. Your answer that you have, divide by 1 plus R. Your answer, divide by 1 plus R. 1 plus R will be 1.09. So I get 0.8417. After that, all I need to do is to just tap. I tap equal sign to give me for year 3, 0.772, 7722. I tap to give me year 4, 0.7084. I tap to give me year 5, 0.6499. See, you just tap. That's a shortcut. That is always our shortcut, right? That is always our shortcut. You just tap as you proceed. So long as you determine for year 1, year 2, you take your answer divide by 1 plus R. Year 3, you just tap equal sign as you continue. You tap equal sign as you continue. So then my present value of our cash flows here, we should be having what? Talk about 2 million times 0.9174. We have a value of 1.8. That is 18,34,800. 2.9 times 0.8417. We have 2,440,930. 3380 times 0.7722. We have 2,610,036. 3,097,500 times 0.7084. 2,194,269. -157,500 times 0.6499. We have 102 -359. So this will give us the present value of our cash flows. Give us the present value of our cash flows, which would be plus 2194, 269, 2610, 036, 2440, 930, 1834, 800. To give us a value of Molino is getting 8 million here, 977,676. This is our present value of our cash inflows, less by our initial outlay, which initial outlay you can see we are given 8 million. So that as at the end of the day, my NPV we should be about 977,676. A very good question. Yeah, a very, very good question. A very, very good question. So that is our NPV of this new machine. NPV of this new machine, which is a positive NPV. Just by based on that, meaning that we can do what? We can go ahead and procure the same. IRR. IRR, my good students, you need to determine now, because my NPV is positive, because our NPV is positive, we have to guess a rate that is higher than 9%. And that's what you're going to do for Mwalimu. You have to guess a rate that is higher than 9%, because your NPV is positive. Pick a rate that is higher than 9%. Any rate that is higher than 9%. Say, for example, here we pick present value interest factor. Maybe we have, say, like any percentage, say like 10%. 10 is higher than 9. 10 is higher than 9. 10 is higher than 9%. We pick a value that is higher than the one that was used to compute original NPV. The one that was used to compute our original NPV. So that in this context, we're going to have 1.1 raised for -1. I get 0.9091. I divide by 1.1 to give us 0.8264 equal sign 0.7513 equal sign 0.6830 equal sign 0.6209. See, you just tap your calculator. You just tap. So that what will be your present value at that rate? Present value at that rate will be 2 million. We multiply by 0.9091, which would give us here 18, 200, 2.9 times 0.8264 to give us 2,396,560. We take 3380 by 0.7513, which would give us 2,539,394. We take 30,97,500. We multiply by 0.6830, which would give us 2,115,593. We take 157,500 times 0.6209, which would give us 97,791 or 792 here. Loss. Confirm, we're having the same values, plus 211, 2,115,593, plus 2,539,394, plus 2,396,560, plus 1,818,200, to give us a value of 8. This is what Mwalimu is getting. I know, believe that that's what you're also getting. 8,771,955 with less 8 million to give us our NPV of 771,955. So that when you apply your IRR, we take lower rate plus NPV of the lower rate minus NPV of the lower rate minus NPV of the higher rate. All of this you multiply by higher rate minus lower rate. See? So in this context, we are taking then lower rate, which is 9%, plus NPV of the lower rate, which is 977,676. We take NPV of the lower rate, 977,676, minus NPV of the lower rate, 771,955. See? We multiply by higher rate, which is 10, minus lower rate, which is 9. So we solve for that. We solve for that. That will give us our IRR. That will give us our IRR, which in this context, we read about 977,676. We divide this one by 977,676 plus 771,955 times 1 plus 9, where we're getting the exact IRR here is 9.59%. So that is our IRR, internal rate of return, 9.59%. Internal rate of return, 9.59%. Confirm if at all you're getting the same values. Confirm if at all you're getting the same values there. Confirm if at all we are getting the same values there. I think the rest you can do. The rest we can do. Like profitability index, PI, we take now, recall, present value of cash inflows, we divide by initial outlay. So like in this case, my present value original was 899,977, 676, we divide by initial outlay, which was 8 million. See, as simple as that, imagine. Nothing complicated. The issue here that you're being tested mainly was to determine that cash flows. Once you have your cash flows, then you're good to go. So now the slippery part with the firm is usually in such a case. Imagine your cash flow was not correct. Imagine you missed on the cash flow. Look at the impact. Look at the impact. You missed on the cash flow. Which mark are you going to get correct after that? Which mark are you going to get correct after that? Maybe only the formulas. You see, because now we find that part A or whatever that you've done on part A will affect part B, will affect part C, will affect part D all the way. So if you mess on the first case, meaning that the rest will not be correct. And that is always a slippery part of the film, nothing more. The same case with FCC. Yes?
They don't mark the workings.
They don't mark, so long as maybe formula. In this case, they won't consider the workings here, unless formula. Like in such a question.
Depreciation.
Yeah?
Depreciation workings like that.
Working, in this case, depreciation work, if at all you get a lenient marker, they can consider giving you like 1 mark or 2 marks for working. But majorly, remember the question was on the required part. See, like in a case, in such a question, for example, see, we are given this required. So not unless you get a mark on the formula, you write a formula there, you write a formula, you write a formula, you write a formula. You can get 1 mark, 1 mark, 1 mark. But correct.
You can easily get 0 from that question.
That's what I'm saying. That is slippery part with the FM. And that's why Mwalimu was saying you must be perfect on the topic that Mwalimu was given us. You see, those 5 topics that I told you, they always tend to relate in that case. And that's why you find that FM, one can do FM so many times to the point that my village people, village elders have sat somewhere, they don't want me to pass this paper. No, it is because the slippery part of FM is accuracy. And for you to earn or to scoop marks, the reason why Mwalimu always say, we seduce this person who is having a paper, we seduce this person. But number one, we create a good impression. Like we have our variables, right? You come and you ask of NPV, just show a formula in PV. You ask of IRR, just show a formula of IRR. In that case, you find that you can easily create a good impression to this person. So that even in workings, at least it'd be like, this person has wasted a lot of ink. Yeah. So let me award him some marks. And that's why, as I've always mentioned again, these papers, always try as much as possible to do all the questions. Why? Because number one, you should never be lied to at they always reduce passing marks if at all a lot of people have not performed well. These majorly, they usually affect, of course, FM, FR, advanced FM, AB. See, don't ever be lied to, like marks will be reduced. So what normally happens is that maybe it has been realized that performance has not been okay. And performance has not been okay because maybe question number 2 is a question that a lot of students have not performed well. So this question number 2 was allocated, say, like 20 marks. So what is going to happen? There'll be reallocation. So you'll find that in this question 20, you'll find that some questions here, maybe we take, say, like 2 questions on each, meaning that this question will go up to 30 marks. So when it goes up to 30 marks, any person who has attempted and he has written something that is making sense, I give that person almost 20 or almost 15. So that any attempt on that, and that's why many attempts you'll find that you pass a paper, you're like, in paper I was anticipating to fail. So what normally happens is the reallocation, where a paper has been performed poorly. They look at a question, either 1 or 2 questions that have been performed poorly, then reallocation happens. So that any attempt, this student will get a maximum points as much as possible. But the pass mark will always remain 50%. It will never go below 50%. It will never go below 50%. And that's why I've always said, always make sure that you attempt all the questions. You attempt all the questions. So my good students, do for me for payback period. So in this class, it will be very easy. Having this question, by the way, we looked at almost major concepts under capital budgeting. So next, I think decision tree is something of 10 minutes. So next class, we do decision tree. Then we also do the adjusted net present value. That one you can easily do, because the rest, I think, the rest will literally flow. So also advantages that most of the blocks again, or other major concepts on your accounts, of course, on your accounts. I think I've done so many questions there for revisions, not only what you're doing here, but of course for revisions, like these are what Let me guide us. This is what you have, yeah. These are what you have for revisions. I think there are so many other questions there in. So we are continuing uploading all these revisions part. But by now, I think you should be having a lot of questions that can help you to do your revisions here. So that is I think the questions now should be quite enough. The questions now should be. I know there are many. There are many questions here. Need to log out. My net. So let me just guide you here very fast. I know that there should be having a lot of questions by now. Majorly for revisions. Yeah. So at this point, other than whatever that you're doing, I think each and every part there are some questions at least 3 questions in addition to whatever that we'll be adding here. See, introduction to capital budgeting. There are various questions which you can take advantage of. So just go through the questions. You'll find that at least each and every topic I've given you some 3 main questions, now including the one that you're doing for revisions here. They really help us a lot. They will help us a lot. So take advantage of that. Then I think we can meet in our next session. Let us meet in our next session. Sorry for keeping you guys. You have a very good night. See you in our next session. Good evening. Bye-bye.